All right, everyone, you know what they say, what happens in Vegas stays in Vegas, and Las Vegas's housing market has a dirty, dirty little secret that no one wants you to know about, and this secret is going to cause real problems for the housing market over the next 6 to 12 months, because right now in Vegas, everyone is seeing 17% year-over-year appreciation, lots of migration in from California, and everyone thinks the housing market in Vegas is great. Well, I got some bad news for you. There could be some tough times around the corner. I'm going to reveal what that dirty little secret is later in this video. In addition, we're also going to take a look at Reno, Nevada. I get a lot of requests from you guys out there who want to know about Reno, the other large metro in Nevada. And so we're going to look at both Vegas and Reno in terms of their underlying real estate investment fundamentals, so you, as a potential home buyer or real estate investor, can make a better decision about if now in 2021 is the right time for you to buy, and if not now, when. Because I think there's some trouble brewing around the corner in both markets. All right, guys, let's get into the data. So we're going to start things off, like usual, on a map. And on this map, we're looking at the geographic location of the Las Vegas metro area, which is here in the southeastern part of Nevada, and then the Reno metro area, which is here in the northwestern part of Nevada. And we have some interesting data for both of these markets. We're looking at home price appreciation over the last 12 months. So we can see in Vegas, across the metro area in Vegas, which includes not only the city of Las Vegas, but then also places like Henderson, North Las Vegas, Summerlin, we can see here that home prices have increased from $297,000 for the typical home last year to $350,000 for the typical home this year. So that's an 18% appreciation rate, and that's pretty far above the US average, around 14 or 15% in the same time frame. So that's Las Vegas's metro area appreciation. Now if we scroll up to Reno, we can actually see here that Reno is doing even better. Reno's typical price has gone from $394,000 to $492,000. 25% appreciation, and that's one of the fastest appreciating markets in America this year, Reno. It's absolutely taking off like a rocket ship. And I think what a lot of you want to know right now as a potential home buyer, a potential real estate investor, you want to know, how real are the prices in both of these markets today? How fundamental are they? Are they backed up by the underlying fundamentals in the market? Or are we going to expect a downward movement or potentially even a crash in prices in these markets going forward? In which case, if you're a buyer, if you're an investor, it would be smart to wait. Well, I'm going to answer both of those questions for you in this video. And so what do I mean by fundamentals of the real estate market? Well, I mean actually the fundamental demand for homes and apartments. And a good way to measure that is by looking at jobs. Historically, the number and the amount of jobs in a metro area and how much it grows, that's historically very, very correlated with appreciation in home prices. And the logic is simple, right? When you add more jobs to an economy, that's a sign that more and more people are moving to the city. More and more people need a place to sleep. They need a house. And thus, the demand for real estate goes up. The prices for real estate goes up. Additionally, when jobs are being created in an economy, it's also a sign that there's a thriving economic system going on, right? If lots and lots of jobs are being created, not only is it a direct increase in demand for real estate, but there's a sign that there's just like other good things going on in this metro that are going to stimulate growth going forward. And so for that, I always love to look at job growth to try to sanity check my real estate market, whichever one I'm looking at. And if I want to understand whether the appreciation I'm seeing is real, I'm going to look at that job growth to see, hopefully, an expanding job count. In the case of Nevada, both Las Vegas and Reno, a lot of that job growth is going to be influenced by inward migration from places like California. In fact, Vegas and Reno receive more inward migration from California than any other metros in America. I think in addition to Phoenix would be the other one. And so understanding in the context of this migration is really, really important. So let's look at the year-over-year changes in jobs in both of these markets. not just over the last couple of years, but over the last 30 years. So you can have some real context about how much these metros are growing and what the current economic situation is like. And so that's what we're doing on this graph. We're getting a terrific insight into the long-term and the short-term economic growth prospects in both Vegas, which is represented by the orange line, and Reno, which is represented by the blue line. And we can see historically that both of these metros are really high growth metros. Like if we go back to the 90s and 2000s, we can see Vegas coming in with 7 to 10% job growth statistics, Reno coming in with 4 to 7% statistics. I mean, that's really good job growth. And just a technical note here, guys, this isn't actually year-over-year job growth, it's 18-month job growth. So basically, take the jobs at a specific point in time and see how much they grew from 18 months prior. One of the first things that jumps off the page, I think, in addition to just really the good long-term growth in these markets, is that recession that occurred from 2008 to around 2011. You can see all of a sudden that both of these lines for Vegas and Reno dipped into heavy negative territory. We had almost 13% job losses in late 2009 in both of these markets. They both got hammered in the last recession, and as a result, their respective housing markets got hammered. I mean, Vegas lost 60% of the value of its housing market in the last housing crash. Reno lost around 50%. So I want you guys to remember that these job declines previously were corresponded with 50 to 60% home price declines in Vegas and Reno in that last crash. It's just an important thing to remember. If you're a potential home buyer, real estate investor in Vegas who's struggling to make the decision about whether you should buy now or wait, please just like this video. I made this video for you guys. I wanted to give you an army with the data you needed to make a better decision. So in return, if you could just hit the like button, that would be greatly appreciated. It would get me more exposure on YouTube and also show this video to more people who are in the same situation as you and just help inform the Vegas home buying population as much as we can. Additionally, also make sure to comment on the video. I want to hear what you're seeing as a buyer or renter in Vegas as well as Reno. What are you seeing on the market? When you guys comment, it makes these videos better. All right, let's get back to it. Of course, these markets then rebounded in the 2010s and got back to positive job growth territory. And interestingly, starting in 2016, for the first time ever, Reno actually kind of overtook Vegas in terms of growing jobs. But then the pandemic hit, right? And you could see the pandemic's impact very clearly on this graph. We had a big drop in jobs in May of 2020 last year, and we've had a kind of slow incremental recovery to the point now where Reno is almost back to its old job count prior to the pandemic, 1.5% lower than it was prior to the pandemic. And that's actually pretty good. Pretty good. Most markets in the US are still below their pre-pandemic job levels. Reno is kind of in the top tier of almost regaining all of those jobs. But we can see that Vegas is definitely not. Vegas is down 10% on its job count compared to 18 months ago, and that is really bad. And you can see that that's pretty comparable to where Vegas was in the last housing crash. And I think this is something that not a lot of people are wanting to talk about or acknowledge about Vegas's economy and housing market right now, is that, you know, the economic fundamentals look really poor. And it's no secret that the pandemic has had a big negative impact on Vegas's economy, because after all, nearly 30% of all the jobs in Las Vegas are based in the leisure and hospitality industry. Think casinos, think nightclubs, hotels, things that basically involve people needing to travel to Vegas and spend money. And of course, the pandemic lowered the amount of people traveling, especially internationally, into Vegas. And as a result, from a structural standpoint, Vegas's economy is still really hurting. It's still in a massive recession and maybe even a depression. I would call a 10% decline in jobs a depression. Now, an interesting point is that these job losses in Vegas have not really shown up yet in the housing market, which is kind of curious, because you would expect normally that if a market lost 1 out of 10 jobs, like if 1 out of 10 people was suddenly unemployed in a certain metro, that there would be severe consequences for that housing market. You know, in home prices going down, foreclosures going up, rents going down. I mean, that's what happened in Vegas last time, 08, 09, 2010, and that hasn't happened yet, right? We looked in the beginning, Vegas's home prices have appreciated by 17% year over year. So what's going on? And the answer really rests in terms of all the federal and fiscal intervention in the housing market over the last year since the pandemic. primarily related to the foreclosure and eviction moratoriums, which have basically meant that a lot of people who have lost their job in Vegas haven't had to move. They haven't had to move out of their apartment or their home. They haven't been foreclosed on. And that basically is shielding the Vegas housing market from bearing the brunt of these massive, massive job losses. Additionally, extended unemployment assistance and fiscal stimulus checks, those are also skewing the Vegas housing market. But the thing I would say is don't get too comfortable with Vegas not feeling these effects, because eventually, if you lose 10% of the jobs in your metro, just as Vegas did in 08-09, there will be consequences for your housing market. You can only duck it for so long. A foreclosure moratorium is actually officially over. That's right, the foreclosure moratorium is over from a federal level. The only thing remaining is that there's a ban on evicting foreclosed households until September 30th. So banks can actually start processing the foreclosures. They just can't evict them out of the home until September 30th. September 30th is also when a lot of the forbearance plans for late mortgage payments are going to expire. And so this has been a long time coming. We'll see if the government tries to extend it again. I don't think they will at this point, at least on the foreclosure side of the equation. And when that really happens, Vegas is going to have some pain, because the amount of people who are mortgage borrowers, homeowners in Vegas not paying their mortgages is extremely high right now. Vegas is actually the #1 metro in America for serious delinquency. Serious delinquency, what's that? Well, serious delinquency is when someone hasn't paid their mortgage payments for over 90 days. So over 90 days past due on paying mortgage payments to your bank. Las Vegas has the highest percentage of homeowners in America who fit that description, and also the biggest increase in serious delinquency since the start of the pandemic. And so you can bet, as the foreclosure moratorium is now off, and as the evictions from foreclosures start in the next month or two, and as the forbearance plans end, Vegas's housing market is going to have some real turbulence. And you can see what I'm talking about here in this report from Black Knight, which each month Black Knight comes out with updated data on the mortgage situation in America, and particularly the delinquent mortgage situation. And what we're looking at here on the green chart with the green heading is the markets with the largest increase in serious delinquency percentage. So again, that's the percentage of borrowers that are more than 90 days past due paying their mortgage payments. And we could see #1 here is Las Vegas, and it's not even close. A 3.8% increase in serious delinquencies. No other market is even close to Vegas in terms of that increase, and their overall level of 5%, 5% of all mortgages in Las Vegas are seriously delinquent as of June 2021. That's tied for the highest in America with New Orleans. And so this underscores the point that as these moratoriums lift and situations return to normal, there's going to be a lot of background pain that was kind of masked from Vegas's housing market that's all of a sudden going to come to the forefront when foreclosures start getting processed, people who lost their jobs start getting kicked out of their homes. I think a lot of people are going to leave Vegas and go to cheaper areas. There's going to be a lot of new inventory hitting the market, and I suspect pretty big price declines in Vegas's market going forward. And in particular, there's certain locations within Las Vegas that you need to be concerned about, right? Not just the metro as a whole, but there's specific pockets of the city that I think are going to be more exposed to price declines going forward based on the demographics and composition of the people that live in that area and the homeowners in those areas. Because just like the last crash, it didn't affect all areas of the metro equally. There were some places that got hit by like 70% last time around, and some places only got hit by 40%. I think we're going to see a similar situation this time, where a disproportionate brunt of the price declines is in specific neighborhoods and locations. I'm going to walk you through them right now. Over here, we're looking at two different maps, both of the Las Vegas metro area. And the one on the left is showing home price growth over the last 5 years by zip code, where the redder shaded the zip code is, the higher the home price growth. So here we have 89030 North Las Vegas. Prices went from $113,000 to $233,000 for the typical home over the last 5 years. That's 100% growth, a doubling in price, and thus it's red shade. And we can see a lot of red in this northern area, northeastern area of the metro. right, in terms of the highest home price growth. The areas to the south have seen lower levels of appreciation as to the areas to the west. Now, what are we looking at on this map on the right? We're looking at poverty rate by zip code, the percentage of households that live in a zip code that fall below the poverty line. And what is immediately evident is that there's a strong correlation here between the zip codes with high price growth and then a high poverty rate. So for instance, 89030, that was kind of the #1 appreciation zip in North Las Vegas. Well, its poverty rate is 30%. Nearly 1 out of 3 households under the poverty line. That's extremely high. Like 15, anything over 15% is high, but to be at 30%, that's really, really elevated. And then, we can see 89101 is 34%, 89106 is 30%, and basically all of the areas on the map on the left with high price growth are also high poverty areas. And you got to be really concerned about those zip codes to the north and northeast in Vegas with high appreciation and high poverty rates, because those are exactly the type of neighborhoods that will get hit hard in a housing crash in general. When you have high appreciation and high poverty, it's not a good combination, but especially when you have this backlog of serious delinquencies, many of which I bet are clustered in those high poverty zip codes. So I suspect there's lots of potential downside in those central to north and northeastern parts of Las Vegas. The areas to the south and to the west, which were blue, lower appreciation, blue, lower poverty rate, I suspect they will be more secure when Vegas's housing market starts to come down. Now, there's one last thing we need to consider, and this is going to bring Reno back into the picture. So if you're someone who's looking to invest in Nevada and potentially you're deciding between Vegas and Reno, or say you live in Reno and you're looking to buy a home and you're deciding whether to wait, looking at this data point that we're going to check out next is going to be really key, because this is often the #1 data point that I point to as showing whether a market is in a housing bubble or not. What's that data point? It's value to earnings ratio. It's taking the typical home price in a market, data reported by Zillow, and dividing it by the annual earnings of the typical worker, which is data that comes from the Bureau of Labor Statistics. And this relationship of home prices and wages and earnings is extremely important, because ultimately it's the amount of money and income that people make that really dictates their ability to afford a home, their ability to get a loan, afford a down payment. And when home prices go up above wages and income, that's a destabilizing sign for the local housing market. And so what we need to do now is check out both Vegas and Reno in terms of their value to earnings ratio, both today and over time, so you can get a sense of if both of these markets are in a bubble today based on this statistic and how that bubble looks compared to what it was in 07. So that's what we're looking at on this graph. The blue line is Reno, the orange line is Vegas, and again, we're looking at value to earnings ratio, taking the typical home price and dividing it by the average earnings of the typical worker. And let's just start with Reno. Here in June 2021, the typical home price or value is $492,000. As we said in the beginning, prices in Reno are really, really high in general, whereas the typical worker only makes $52,000 annually in Reno. So that's a 9.5x multiple, the home price, the home value over the annual earnings. We can see that in Vegas it's 7.7, which is a much more reasonable level than the 9.5 in Reno. And this is a situation where buying into a housing bubble, right, which I think we're in August 2021, you would rather your value to earnings ratio in your city be lower. Because what that says is that prices are more thoroughly supported by how much money people make. And the higher the value the earnings gets, the more disconnected the market gets from the earnings and wage fundamentals. And we can see in Reno that over the last year, value to earnings has spiked. It was at 7.6 in August 2020, which I would have said was a pretty healthy level given to where it was historically, and it spiked all the way up to 9.5. And that's the result of prices going up a lot, but wages also going down somewhat in Reno over the last year. And that says to me that this market is in a bubble, right? When we are at 9.5 value to earnings, which is just high in general. That's just high in general. I mean, let me actually just give you an example of another market that maybe isn't as bubbly as Reno or Vegas. Like if we were to look at, I don't know, Columbus, Ohio, you can see value to earnings in Columbus is 5.5. compared to 9.5 in Reno. And not only is it 5.5 in Columbus, but it hasn't really gone up that much over the last year. Whereas we have a much higher VE in Reno and it's gone way up. So that just gives you some perspective on how expensive Reno is looking today. Now, the good news is it isn't as expensive as it was back in 07 when VE was 10.7, when the typical price was $367,000 compared to annual earnings of $34,000. So Reno is cheaper than it was in 07. So that's why I don't think another 50% decline in home prices is necessarily in the cards. But the market's definitely looking frothy, as is the market in Vegas, because we can also see in Vegas value to earnings has gone up a lot recently over the last year, and it's gone up a lot when, you know, there's been a lot of job losses and a lot of seriously delinquent loans. So what should you do if you're a home buyer, real estate investor in Vegas? Should you buy now or should you wait for the inevitable crash? And I think the answer to that question really depends on your outlook and your perspective as a home buyer. Are you someone who has a really long-term outlook? Like, will you be buying this property and either living in it for 10 years or owning it for 10 years in investment property? If so, you could still buy in these markets today and be okay. You just need to understand that if you buy in these markets today, there's a lot of risk factors which suggest 20 to 30% price declines are definitely possible. And you need to understand and ask yourself, would you be okay both mentally and financially dealing with that over a couple years if the value of your property went down by 20 or 30%? Now, the good news is that these are really historically strong growth markets, so if values go down by 20 or 30% over a couple of years, they're going to go back up, just like they always do. And so really understanding whether your perspective is short-term or long-term is important, as well as like how much cash you have to support a property if all of a sudden there's a correction, maybe you're not able to rent it out. If it's an investment property, you need to carry it for a little bit and pay the expenses. Like, what's your ability to do that? Me, myself, I'm not going to be buying in these markets because their value to earnings ratios are just way too high and they're accelerating too fast, in my opinion, for a real estate market that I would want to invest in. And in particular in Vegas, that serious delinquency situation is going to mean lots of foreclosures coming down the pike over the next 6 to 12 months, which I think is going to further destabilize the market. So as always, guys, I love providing this data to you. If you are a home buyer or investor in Vegas, make sure to leave a comment on this video. I want to hear what you're seeing in the market. Is what I'm saying making sense to you? What are your perceptions? When you guys comment, it makes me more informed. It makes these videos better. Additionally, if you haven't subscribed to the channel yet, make sure to do that. I come out with 3 of these videos per week, spend a lot of time putting together data so you as a home buyer or real estate investor can make a more informed decision. So you're not going to want to miss this content going forward. Make sure to subscribe. Additionally, if you really like this video and you want to support the channel financially, think about becoming a member, joining the channel as a sponsor. The cost is $5 a month. You support me financially here on YouTube, but in addition, you get some really cool perks. Actually, there's a exclusive members only message board here on YouTube that I post on almost every day. I post graphs, I post data that I don't post anywhere else, only for YouTube Reventure sponsor members. I also post polls so you can help me decide which videos I'm going to do. The whole reason I picked Vegas was because I posted a poll to the member board and you guys voted for Vegas as the one that you wanted to see. So if you really do enjoy this content, you want those perks, think about becoming a channel member. There's a link in the description. All right, guys, this is Nick from Reventure Consulting. Until next time, see ya.